More whole life insurance was purchased in the 40s, 50s, 60s, and 70s than ever. It was the creation of qualified plans of 401ks and IRAs and all this stuff that has led to the problems that we're in right now.
So the bottom line here is, the disadvantage is there is a different loan provision and percentage when you're borrowing from whole life than a wash loan.
Yeah.
But there's a control of the premium, a control of the interest and dividend. There's once it's paid, there's a control over the death benefit being there contractually. And there's control over the cost of insurance primarily. Where right now in IUL, there is a guaranteed, but it's very different than what's being illustrated, and people are then looking at the illustrations in a very erroneous way because it's not accurate. What's up, Chris?
What's happening?
You're always making trouble on the internet.
I do this.
Out there calling people out, and then they won't debate you. You've offered to go be in person, so we're relegated to just reacting to their videos. Which is fun.
It's sad. I got to tell a little bit of backstory here. So this guy called me out one time, made a video debunking me on my perspective of IUL, and then I kind of called him out in his comments, and then self-admittedly, in the comments, he admitted that, I haven't really watched much of your content. I just saw this one video, and he deducted all this stuff from it. I made a video responding to him. I challenged him to a debate, and I'm like, David, if you're so confident, this is your opportunity to put me in my place and show the world that you're right, I'm wrong, all this stuff. And then I offered to debate him. He said he couldn't. He lived in Puerto Rico. I said, don't threaten me with a good time. I'll fly to Puerto Rico anytime. And, we're moving to the Dominican pretty shortly. We'll be like neighbors, David. Let's go. But I'll fly and that offer still stands.
He wrote a book.
He wrote a book, Power Zero, Look Before You LIRP, which is life insurance retirement plan, which, how do you feel about that?
I don't love the term. I don't love the concept of retirement plan with insurance either. So I'm sure we'll have some reaction.
Yeah, we'll have some. So let's get it. This video is all about, IUL over whole life, why he, and I haven't watched it all. I saw the title. It's a newer video of his, but it's 2 reasons he prefers IUL over whole life. So let's go.
In today's video, you'll see part 2 of my interview with certified financial planner professional Brent Bowden, in which we discuss 2 reasons why I prefer index universal life over whole life.
Just talk a little bit about the difference. There's tons of different types of cash value life insurance policies. Why do you like the IUL over kind of the older?
First off, same haircut. Yeah. Digging it. Similar beard. It's almost like father-son that we're watching here.
Whole life policy, and what makes that different. Obviously, there's also variable ones out there for people who want to be a little riskier, but the IUL.
For people who want to be a little riskier.
Did he just insinuate that IUL wasn't risky?
Right. And for people that want to be a little riskier, let's debunk that for a minute. People believe risk equals return. And that erroneous belief leads people to take unnecessary risk that confiscates wealth.
Completely.
This is a big part of why I wrote Killing Sacred Cows. I was so frustrated with people being like, risk means chance of losing. So how does increasing your chance of losing help you win? We want people to mitigate their risk. I work with so many entrepreneurs that are taking plenty of risk in their business. They're creating new products with intellectual property. Real estate investors that you work with, they're taking calculated risks with that. Why do they now want to take and put their money in something they know even less about and take a bunch of risk when they already have other things that they have a lot more control and influence over that they're taking risk on? So just that quick little statement that was like, some people want to take a little more risk. Well, right now, if you're doing IUL versus whole life, you've actually already chosen to take more risk.
Yeah, 100%.
Tends to be one that I like a lot for some features, but what's your opinion on that?
I like the IUL over, say, whole life, and I've got a lot of people that read The Power of Zero who utilize whole life. So I'm not historically been one to dump on whole life. I think it has a place. But one of the issues with whole life are the loan.
I don't usually dump on whole life, but I'm about to dump on whole life.
Provisions. So the question becomes, how do you get money out of these policies?
Interesting term too, dump.
Yeah, exactly.
It's like, okay.
Yep.
Crap.
Yeah, exactly.
Here we go.
These tax-free. And the reality is the best way to do it is by way of what we call a policy loan. And basically what you're doing is you're taking a loan from the life insurance company.
Okay. From the life insurance. That's good.
Yep.
They're charging you a rate of interest. And at the same time, the insurance company is taking money out of your cash value and they're putting in what I call a loan collateral account. and they're charging you they're crediting you a rate of interest. So you've got two sides of the ledger here. You got the insurance company that's charging you a rate of interest, and then they're crediting you back a rate of interest in the money that's been placed into that loan collateral account. I've seen life insurance policies where they charge you they charge you 8%, but they credit you back only 4%. So,
yeah, I mean,
where are those?
So here's the deal. Like he's gonna come at this from a place of, I think a big thing he does. I don't know if he's gonna go here in this video, but a big component that he focuses on is what he calls
Loan arbitrage.
the 0% loan provision, which isn't even really a thing, by the way. That's him basically saying, that's his terminology.
Wash loan, as they call it.
It's the wash loan, right? So if you're going to earn 4% or pay 4%, you're going to earn 4%. And so it's going to cancel each other out. So it's a 0% loan provision, right? Like that's where he's going for. And I haven't seen this, but like, I bet you he's about to say you can't do that in whole life.
in other words, there's a net cost of borrowing of 4%. And that doesn't seem like a big deal, but that interest grows and compounds over time. And if you don't pay that interest back at the end of the year, they subtract it from your cash value. And then the next year you take another loan, they charge you another 4%, but you haven't paid back the loan from the first year. So now you're paying the interest from the first year and the interest from the second year. And that snowballs and compounds to the point where it could really force you to run out of money in your life insurance policy 10 to 15 years faster than you were anticipating, at which time you get this tax bill.
We'd be like, yeah, you shouldn't do that.
Yeah, I mean, he's hitting the nail on the head. That's the problem. And so
we're on the same page so far. Where's the turn?
Yeah, exactly.
Right. And you lose your death benefit. So it can be really bad. It's like,
and man, if you do that with IUL, it's a policy lapse, or with any policy, it's a policy lapse. And now you could owe tax on those gains.
Not just the gains, you owe tax on all the loans that are outstanding too. It's really ugly.
It's like getting divorced. You know, a lot of bad stuff happens when you get divorced. You don't want this to happen to your life insurance policy. So I make the case that the only time you should really be married to a life insurance policy, you know, for the rest of your life, is if you have a 0% loan provision. Now, I got to warn you, some companies out there say we'll start you at 0, but we reserve the right to change you to 1, 2, 4, or 8 when, you know, at our leisure. That's no good either, because if you give a life insurance company 40 years to make up their mind, their fox is in your chicken coop. And I can guarantee that at some point
we're in alignment with that, right?
Yeah, I mean, yes and no. I mean, he's talking about like the 0% loan provision. The problem that I have, and I know he's going to go here, so I'm just going to call it before he does because it's on my mind. He's talking about the 0% loan provision. The problem is when you run a wash loan, he's talking about the fact that he's comparing apples to apple, or he's comparing apples to oranges, but he's pretending he's comparing apples to apples. So he's saying in IUL, you have this wash loan provision option, right? And so therefore you can control the loan costs. So therefore you're protected, right? And he's going to say that you can't do that in whole life, which whole life is a much more predictable. You may not control it completely, but it's certainly more predictable, and you can, you can.
And he's going to neglect mentioning M&E mortality costs changing in IUL,
exactly,
and the term chassis, you know, with
100%.
that cost going up over time through mortality.
And when you run illustrations with IUL, and you run the index loan or participating loan or variable loan option, it's all the same thing. Different companies call them basically by those three names. You are building in 50 basis points of positive arbitrage on the illustration. That's not how it's going to really work, but you're injecting a ton more risk.
0.5% of gain essentially, because you're going to make more than the borrowing cost.
And what happens is that makes it so the illustrated income,
amazing.
It looks sexy. It's like, it's sexy.
Yeah.
Time they're going to change things in their favor. So I really prefer LIRPs that have a guarantee.
So first off, LIRP is a term he made up.
Yeah.
Life Insurance Retirement Plan.
Good marketing play.
Good marketing play, but that's not a real thing.
Yeah.
It's just an indexed universal life policy.
Yes.
Okay.
Yeah.
Guaranteed
Just wanted to be clear.
0% loan, ironclad loan provision. It's guaranteed in the contract. They can.
Let's say this too. Like, he wrote the book, The Power of Zero. He wrote the Look Before You LIRP. And the whole idea behind this, like, I agree with a lot of the things he says. A lot of the stuff he talks about in The Power of Zero, the taxing, the benefits of taxation, and the idea of getting to a 0% tax bracket, not being able to do it without life insurance and all these different things.
It's just the chassis he's using.
I agree with 95% of it. The problem is, my problem with it from a principal perspective is that he's using all these concepts to push IUL sales through his IMO. Like, you know, and it's all to push this product that is actually injecting a ton more risk into your personal financial world than you realize. And it's a highly complicated, highly sophisticated, much more risky
like
product.
10 to 1 people selling IUL versus whole life?
At least it's crazy now. Like, I don't even know the number, but it's probably more than that at this point in time.
Never ever change it because you want that loan provision to be tax-free and cost-free. All loan provisions.
Okay, first off, how could it be cost-free?
Yeah.
That's a technical, like, let's talk about that technicality, because you're no longer earning the index if you're at a wash loan, are you?
Well, he's saying that it's he's saying he's going to use the wash loan. So you're paying 4%, earning 4%.
But you're giving up the upside.
You're giving up the upside.
Which is a cost.
Which is a cost.
It is a cost. I'm just saying, like, we have to talk about the full economic structure.
But it's even more than that, because there's a cost of the net amount at risk, and because of the annual
when you take
renewal,
a loan, does it change the net amount at risk?
It doesn't. No. So when you take, let's say you're 65, when you take your first LIRP payment, right? Like first LIRP income payment, and you have $200,000 net amount at risk, you're paying annual renewable term. So if you do a wash loan now next year, and you haven't eaten into that net amount at risk like all these IUL agents say you do, so the older you get, the more expensive the cost of that $200,000 death benefit. And so there's absolutely a cost in this 0% loan provision.
So let me be clear. When you take a loan that's a wash loan, that does or doesn't count against your net amount at risk.
It does not reduce your net amount at risk.
It doesn't increase it.
It doesn't increase it either. It'll keep it the same.
Keeps it the same.
Okay. So
that's good.
But when it keeps it the same,
but you give up the upside of the index.
But you're also that amount. Your cost of that same amount of net amount at risk goes up every single year. Right.
Of whatever is at
whatever it is
because of mortality. Right.
Exactly.
Which, if that lapses, creates a major problem.
Provisions are tax-free, but they're not all cost-free. And so the devil's in the details when it comes to those loan provisions. And IULs have certain IULs with certain carriers have guaranteed loan provisions, 0% loan provisions. Whole life policies do not. And if the goal is to build money up, so
let's talk about that. Yeah. Whole life loan provisions, direct recognition, non-direct recognition.
Correct.
Those two things, and what we're dealing with differences in loan, because it isn't going to be a wash loan.
No, it's not. I mean, this could be a video on its own that could be a half hour long explaining this. So to keep it really simple, when you borrow against a whole life policy, there is going to be a cost to it, right? It's not positive arbitrage. It's not a wash. In a non-direct recognition company, if the environment were a specific way and the policy is old enough, like, over the past 20 years, and if the policy were 25 years old and it could work, and you could actually have positive arbitrage. Right now, if you're entering that retirement, it's not going to be there, right? You're going to be upside down. You're going to have an extra expense. But here's the deal. Dr. Wade Pfau talks about this all the time. Like, there are controllable elements, right? And the variables are much more predictable because, and it's like anything else in the economy, when we can predict something and when we know something's going to happen and the variables are controllable.
There's economic value of that. Certainly.
Right. Exactly. And the problem with IUL is he's trying to just position it like
only the loan provision,
but
not talking about the lack of control of the mortality cost.
Exactly. Which is
a much higher risk than the difference in what you're paying on your loan versus receiving in your dividend.
Equally as important. It's more important when you scale the variables and the comparisons against a whole life policy, and you say, all right, whole life is gonna maybe not be able to have this wash loan guaranteed. There may be a cost, there may be positive arbitrage, there may be a benefit.
Just depends on the time.
Who knows?
But it's not guaranteed.
But at least the standard deviation of that is much smaller, right? Like, so it's more controllable, more predictable. So when you're planning out your retirement income planning or your cash flow plan and retirement, you can manage that much more effectively.
Because the cost of insurance can start eating away at your cash 100%. Value.
Yep.
Where predictably what the loan interest rate is for that year.
Exactly.
Right.
Yeah.
Okay. Got it.
So that somewhere down the road, you can take it out and spend it on your lifestyle at a period in time when tax rates are likely to be dramatically higher than they are today. Then the loan provision really becomes almost the most important provision in the entire contract because it determines.
Almost. He missed that.
Almost.
That lapse guarantee is going to be really important if you can make it there. And the cost of insurance, where it ends up, because there's the guaranteed cost and then there's the current cost.
Right.
And that depends on how many people are dying per 1,000 that own the policy. That tends to get increased in older age. And what they're counting on is you're going to have a lot of cash value in comparison to the death benefit, so that even though the cost of insurance is going up, the net amount at risk is going down because of that cash value.
And what you'll find is if you run these and you're looking at an illustration and somebody runs like an index, everybody runs these when you're an agent. The IUL agents out there run the index loans or participating loans because it increases your income by 50 to 100% compared to what it would run at a wash loan. Because and so you need to, if you're going to,
so at least he's mitigating risk with the loan where other people are exacerbating.
Sure,
it,
yeah,
but not acknowledging this really important variable of the cost of insurance.
And I will say, like, on the scale, to give David credit, like on the scale of IUL agents, he's one of the better, right? Like as far as like his conservative nature, but like this is still very misleading.
Let's see what this other important provision is.
Yes.
It determines how much of your money you can get and at what price. So that's why I like IULs, particularly IULs that have guaranteed 0% loan provisions.
And I think another provision that, I always like to talk to.
It's we're both smashing buttons over here. Like that, it bugs me hearing him say, particularly companies that have the 0% loan. No company has a 0% loan provision. That is a marketing term like a LIRP. It's not a 0% loan. It's a wash loan. You have compounding
4%
interest,
cost,
4%, and then compounding crediting, right? That's going to happen, right? Or crediting that you're getting every year. And so like at any point
but
in
it's
time,
not like, it's, you know what it reminds me of? 0% financing or $3,000 cash back.
Right.
It's not a 0% loan because you forfeit the $3,000 cash back.
100%.
Right. Not exactly the same, but it's ultimately language matters. And you're paying for and you're getting for, so that I'm fine with that being called a wash.
Totally.
But calling it a 0% loan, it's a 4% loan.
Yeah, you're insinuating that there's no loan expense at all.
Right.
Because the other thing is you can change your loan declaration every single year, right? And so if you change it, all of a sudden you still have all these loan expenses.
Yeah.
You know what I mean? And so it's not like there's nothing there.
I always like to talk to potential clients about is just, medical professionals are very busy. They're moving all the time and, don't have a ton of extra time to do some of that legwork. And market volatility is another thing that comes into play for them. Managing as many risks as they can. I think an IUL does a great job of it in contrast to some of the other cash value life insurance policies.
A great job of what?
I don't know.
Of managing the risk?
So what does the IUL purport to do? The IUL purports to give you exposure to the upside of the market with a guarantee against market loss. It's nothing exotic here. So you're getting.
And I agree with that. But what we're not talking about is the options budget and the cost of insurance. It's built on a term chassis.
And the options cost.
And the options cost.
Yeah.
So, okay, that's a very simple way of describing it without these major factors that impact and have major implications.
Right. Because you're never really invested in the market. You're doing it through an options strategy. Right. Like, and to me, the reason I don't like IUL is we talked about it last time I was up here. We both love win-win scenarios, right? We both believe life insurance companies, their strength is managing risk. So when you go away from whole life and you go to index universal life, you're taking the power and the strength of the insurance company away from them because they manage risk. And you're saying, listen, take the guarantees that you were going to give me that you guys manage great on a long-term basis and just go put it on black. That's really what they're doing. If you understand options. And so you're taking the strength of the insurance company away from them and you're saying, just go play roulette.
Yeah. And they're only talking about part of the story there.
Yeah.
Exposure to the upward movement of a stock market index, say the S&P 500, and you have a guarantee that you won't lose money as a result of the market.
Okay, that's true on your cash value account. It's not true on the cost of insurance.
True.
So here's the thing. Yes, they're not going to come and take anything out of the bucket, but the cost of insurance is the leak in the bucket.
Yeah.
So you don't know how big those leaks are going to be.
Right.
Unless you look at the guaranteed side. Now, the guaranteed side's never going to happen from the early years. It happens over time.
Sure.
But where I'm really concerned is when people are 70 and 80 years old, and we have even more longevity in the future, right? But what happens is if you're healthy, you're going to get a new policy.
Yep.
If you're unhealthy, you're going to be stuck with other unhealthy people.
Yeah.
That's going to raise your cost of insurance at a time when you're supposed to be using it as a retirement plan, and it's being eaten at from the higher cost of insurance.
100%. Yeah.
And if the market underperforms over time, they don't have enough options budget. The options don't perform well because there's not enough market volatility, because volatility makes a big difference with options.
Totally.
Ultimately, you might just end up with a lot less money than you thought. So why take risk in what I would be using as an alternative to savings, not an alternative to the market?
100%. And I'm not going to sit here and tell you can't have years in an IUL that are better than a whole life policy, because you absolutely can. And you probably will, right? But we're talking about a 30-year, 20-year, 15-year, whatever time frame. And so it's about what does it look like
30, 40, and 50 years from today.
But
they're looking at numbers as if everything's going the way it's going now.
Right.
Now, you may have a flat year in which the market went down and they credit you a zero, but they still take out the insurance expenses. So you're not guaranteed to lose money in any given year, because you could have a 0% credit and they're still taking out the insurance expenses, but they guarantee that you'll never lose money in the market. Okay.
Right. So he does.
He at least acknowledges that.
What sort of rate of return might someone be able to expect in their IUL over the course of a lifetime? Well, it's not going to be stock market like returns. It's going to be,
I see why you say he's one of the better ones.
Yeah. Oh, yeah. He's definitely.
Returns. And what I typically tell people is between 5 to 7% net.
What do you think?
I think that's based on the history that we've been seeing so far. And he's going to show.
That's really like way more close to reality than when most people are talking 8 to 12. Like when we did the other reaction video, he was saying 10.
Yeah. And here's the deal. Like,
not him, Doug.
Like, David McKnight here has been saying you can get 7 to 8%, and he's going to say, well, companies will show this. He does a lot of videos that show graphs of what the companies say you actually get. That's not what you actually get credited for. That's like what the index strategy has been. That's kind of like,
because we have to know the budget.
You're right. That's like the gross benefit. Then you back out the net cost and everything after cost of insurance and everything. And so, like, at the end of the day, like I said, I don't think it's going to be 7%. I think it's going to be more in the 4.5% to 5%. Right. But that's just in today's economic environment. It could go up.
We don't know what it's going to be like. Yeah.
Right.
Net of fees over the life of the program. Well, guess what? If you can get 5 to 7% net of fees without taking any more market risk than what you're accustomed to taking in your savings account, that's a pretty safe and productive.
Okay, that's an issue. Yeah. Without taking any more risk than you used to taking in your savings account.
Yeah.
Your savings account, your bank doesn't go, hey, depending on our, performance and other savings in our loan, we might just start taking some of that savings account out through cost. That's where exactly he lost me right there.
And that's where you and I talk about whole life insurance as a savings alternative, because it's got the same profile, right? You can't.
Right, they're saying this is like savings, but with return.
Right. But you're also injecting a ton more risk, which goes against the whole purpose of using life insurance.
So it's not a savings alternative.
Right. Exactly.
Productive way to grow at least a portion of your portfolio. Now let's go back to your doctors and your healthcare professionals that are growing money outside of their retirement plan inside that brokerage account. And they're in a high marginal tax bracket. Let's assume they could get a 6% rate of return in their IUL. What rate of return would they have to get in their stock market portfolio in that taxable bucket, assuming it's all short-term capital gains? What rate of return would they have to get in that bucket to be able to eclipse that 6% rate of return in the IUL? Well, you do the whole thing where you divide 6% by 1 minus their marginal tax bracket, and that gets you to somewhere on the order of 9%, okay, for these people in the higher marginal tax rate. So in other words, if you were to...
As long as the policy doesn't lapse.
Yeah, exactly.
Then you're in a lot of trouble.
Yeah.
But nobody's talking about here. I've said similar things.
Yeah, but the problem is, like, you're not going to know. The reason I can't stand IUL is because you're not going to know that you have a problem until it's too late.
Right.
Have the choice between an IUL versus growing money in a stock portfolio in your taxable bucket, your brokerage account. What rate of return would you be required to get to in the end net more
So
money than
what he's talking about here, you and I both have a huge issue with, because he's still kind of like doing this comparison, stock market versus insurance. And he's still coming at it from like the retirement mindset, this accumulative kind of distribution, like it's not value creation. It's not like investing in yourself. It's not like, you know what I mean? Like building anything of value. It's an easier sale. It's an easier conversation, you know, and I think that's why IULs are selling so many, because it's easy to kind of deceive people based on the illustrations and then have a conversation with them that they're accustomed to hearing, right? Mm-hmm. And this is kind of pitched as an alternative to a 401k, an alternative to an IRA, or a rich man's Roth is what a lot of people call it, because you can't, if you're a high net worth earner, you can't contribute to a Roth, but you could do an IUL. That's what they're trying to position, right?
But it's very different vehicles.
But this is
a Roth never going to come in with expenses in the future and be like, hey, you know what? Based upon the performance of Roth, we're going to start charging 5%.
Exactly. Yeah.
Net more money than you would if you just invested in IUL. You'd have to get 9%, and you have to take all the risk commensurate to that 9% rate of return. And so now all of a sudden you're saying, wow, I can get tax-free growth. Even if it's growing only at 6%, that's probably superior to what I could get in a stock portfolio. Plus I get a death benefit that also doubles as long-term care. And so this is why I think for people that you're addressing day in and day out, the IUL becomes a very, very compelling alternative for people that are growing money in that taxable bucket.
Yeah, absolutely. And that's 9% net of fees. So
that's right.
If you have an advisor doing that for you, and then you still have to.
So they're saying that the 5 to 7 is net of fees.
Yeah. I mean, like, it could happen. It could. But like, here's the deal. We've been for a decade. We've been in the lowest interest rate environment. We had the greatest bull run of all time. Once again, I'm going to go back to my IUL challenge, and like, we came through the greatest bull run of all time with a product. He just said it here, provides upside potential due to market participation, right? We just came through the greatest bull run of all time. The IUL challenge says, just show me one illustration that outperformed the conservative illustration it was sold based on, because they all tell you it's conservative. And if we just had a great bull run, you should have participated in the upside. Right. But nobody did. Nobody has. And anybody that can show me, I'll pay you $2,500.
Yeah. Yep.
To account for that. So
that's right.
Yeah. Well, shifting a little bit. So we talked a lot, I know in your book, about kind of the tax ramifications, as well as, you know, some of the strategies that you look at. What's your thoughts on?
He needs to see a sleep doctor, man. He's really tired.
Yeah.
Building a team for professionals. So, you know, financial planning a lot of times doesn't take just one person to be able to exhibit the best experts. You know, who do you like to include on your team when you're working with clients?
Well, I think you have to have like-minded professionals. Not all CPAs, for example, buy into the tax-free paradigm. So think about what CPAs do. They're in the business of saving you taxes today. They know that they have a higher likelihood of keeping their job if they can, say, get you a tax refund at the end of the year, or help you maximize your tax deductions on the front end. Well, guess what? My particular view of the retirement universe is not necessarily focused on maximizing tax deductions at historically low tax rates, so that we can postpone the payment of those taxes till a point sometime in the future. So I think having a CPA, if you're interested in shielding yourself from the impact of higher taxes, having a CPA that's cognizant of that paradigm, or cognizant of the fiscal landscape of our country moving forward, that also believes that tax rates in the future are likely to be dramatically higher than they are today. I think it's,
if Mark's watching,
listen
to that.
I think it's important to have those types of people on board. Same as far as attorneys go. I think it's just important to make sure that this team that you're building around you is like-minded, that they're on the same page when it comes to, because the Power of Zero tax-free paradigm is diametrically opposed, if you will.
I give it to him, man. He believes in it. He moved to Puerto Rico.
Yeah.
Right.
Yeah.
So it might be 0% on a lot of stuff like capital gains and crypto and whatever. But then, 4%, 15% at most, probably paying in tax. So that's part of this Power of Zero concept.
Like I said, 90% of what he's like,
it's just
great.
the uncalculated risk of what the IUL brings. Yeah.
To the tax deferred paradigm. The tax deferred paradigm, get all the deductions that you can today because you're going to be in a lower tax bracket in retirement. That's exactly the opposite of how we see things going down over the next 20 to 30 years. And so you need an attorney, you need a CPA, but you need these people to all be on the same page. And so I usually recommend you giving a copy of The Power is Here to them and then just standing back and seeing how they react, right? And a lot of people read that book and they have an epiphany and they change right there on the spot.
Yeah, well, it's certainly interesting in the foreword to have Ed Slott on there. That certainly helps give some gravitas to the book. So his opinions are always well respected in the CPA landscape.
Right. No, and people say you're probably familiar with the white coat investor since he runs in the same.
He and I almost debated back in the day, long ago.
Really?
Yeah, I was set up and don't know what happened when I got canceled, but he was actually pretty kind about killing
chill.
sacred cows.
Really?
He reviewed it. He had things to say about it. He disagreed with mainly my stance on the market.
Yeah.
Called me out for straw man on something. Like there was a couple points I'm like, yeah, I get it.
All
See where he's coming from. But I was like excited to do that debate.
Oh, that would have been amazing. But he bailed.
No, someone knew the two of us and told me it was going to happen.
He runs in the same space. He'll say, name one retirement expert out there that is in favor of cash value life insurance. I'd say I'm happy to. And I quote Ed Slott. He's got a whole PBS special on why cash value life insurance can do some things that nothing else can do. He says that cash value life insurance and Roth IRAs will do more to minimize or eliminate taxes from your retirement plan.
I just want to say cash value life insurance, by the way, includes whole life insurance. And so the purpose of this video, the title of this video is 2 reasons I prefer IUL over whole life. And from what we've heard, there's been one, and that one was just like a horrible example, right? Because it doesn't really solve the problem. You're still injecting more risk.
Yeah.
Whole life, you have more control over the variables, more predictability over the variables. So the rest of whatever you have going on, you're going to be able to manage your whole situation much more effectively.
Yeah.
And from your heirs, from the taxes your heirs would have to pay than any other combination of investments. And so Ed Slott is very ahead of his time when it comes to those things, which is why I asked Ed Slott to do the foreword for my book. So
here's the deal. That last statement, like Ed Slott being ahead of his time, it's not ahead of his time. I was going through Pirates of Manhattan by Barry Dyke the other day. Every now and then I like to go through that book because it's just like so awesome. Like there's so many spreadsheets. I'm that nerd that just loves to get into that stuff. He had this one sheet on there that was talking about percentage of life insurance owned per capita from 1945 to today. And did you know that there was more life insurance owned in 1965 with half of the amount of our population? There was more life insurance policies in force in 1965 than there are today with half the amount of population. Think about that. Like, that's mind-numbing. That shows a cultural problem that we have right now. And we wonder why we're going broke. And so like Ed Slott, he's an older guy. Like this is not like a new revelation. This is like a throwback way of doing things. This is a way of like managing money. More whole life insurance was purchased in the 40s, 50s, 60s, and 70s than ever. It was the creation of qualified plans and 401ks and IRAs and all this stuff that has led to the problems that we're in right now, And he's trying to act like he's like revolutionary and like a thought leader.
So the bottom line here is, the disadvantage is there is a different loan provision and percentage when you're borrowing from whole life than a wash loan.
Yeah.
But there's a control of the premium, a control of the interest and dividend. There's once it's paid, there's a control over the death benefit being there contractually. And there's control over the cost of insurance primarily. Yeah. Where right now in IUL, there is a guaranteed, but it's very different than what's being illustrated, and people are then looking at the illustrations in a very erroneous way because it's not accurate.
The fascinating thing about IUL is every time you get to control one element, there's always another element
that can move. Too many levers moving.
Exactly.
Alternative to savings. We're talking about whole life.
Yep.
IUL is not an alternative to savings.
If you want to say it's an investment alternative, IUL, you could use that phrase maybe because it comes with a lot of risk.
Yeah.
And I would just say it's a bad investment alternative.
All right, there you have it. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.